Hello, 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 and welcome to the Sigma Max Capital YouTube channel. So I don't want to go on a long rant about what this channel is going to include for now, and I kind of want to get straight to the point. But what this channel is about, it's all about finance, markets, contrarian opinions, all that good stuff. And so yeah, today we're going to be talking about a shift in the global markets. And I first want to say what a crazy day or week to be filming this. I mean, you know, tomorrow morning in US markets, God knows what's going to happen. I mean, no, anything could happen. These tariffs and the sentiment that has um, followed through with them is absolutely mental. I mean, I've never seen anything like it in my lifetime or in my investing lifetime either. Um, yeah, it's mental. And I mean, I've been on Twitter already today and I've already seen there's been lots and lots of countries that have had a halt to their trading. Um, so so yeah, the circuit breakers so far in the past, like this was 40 minutes ago, China, Taiwan, Japan, Russell Futures, Australia, and Singapore have all had circuit breakers. So yeah, tomorrow will be extremely exciting, um, to say the least. But anyway, to get on with this, uh, first is a quick disclaimer, guys. The following content is not for educational, is for educational and informational purposes only and reflects my personal opinions and insights. It is not financial advice. I'm not a licensed financial advisor, and nothing in this video should be interpreted as recommendation to buy, sell, or hold any financial asset. Always conduct your own research and speak to a qualified advisor before making any investment decisions. Investing involves risk and you may lose money. Past performance not of guarantee of future results. So, today's topic is all about the US debt crisis. You know, the US debt now is, I mean, what is it? It's 34 trillion, something like that. I mean, I don't even follow it all the time now. It's pretty mental. But you know, th this this has been happening since the 70s. The US has been operating in a budget deficit since the 70s, so that's pushing 50 plus years now. Um, and there are consequences to this. Y- The era of easy money and low interest rates, it all has to come to an end at some point. And last year, the net interest of the US debt exceeded that of defense spending. And I mean, I'm pretty sure the US defense spending is 9 times more than the country with the second largest defense budget. And so that shows how much, the defense spending last year was 842 billion and the interest was 881 billion. I mean, how mental is that? And then it's projected to be 1 trillion in 2026. I mean, we're already in 2025, guys. Like, you know, I mean, God, this is mental. But anyway, so this is a problem because they're not collecting that much um, through receipts, tax receipts, and the only way to pay this off is there's two options, all right? Cut spending or print to go Brrrr, right? So to cut spending, I highly doubt this will ever happen because they're going to have to make some extremely unpopular decisions that, quite frankly, no politician would make because it's too unpopular. I mean, they'd have to cut social security, health spending, all of that, and they can't afford to do that. Nobody would vote for them, so that's not going to happen. And so this is quite general, but the only way I see anything turning out over the next decade, 2 decades, is higher inflation. I mean, you know. Um, so these chronic budget deficits, they've been happening since the 70s, as I've said. And if you think about the past few decades, in the past few decades, we've had extremely low borrowing costs. So we've just had easy money, as you'd say. And this is what's led to all of these highly overvalued companies with mental growth rates, kind of built into the stock price. I mean, look at, you know, since over the past decade, 15 years, we've had all of these tech companies with high valuations. I mean, you know, for example, Tesla, part of the Mag 7, they've got a PE ratio. This is currently after it having dropped, um, you know, I mean, what's it down on the month? 10% on the month. It's got a PE ratio of 117. And if you compare that to Toyota, um, I mean, they've got a PE ratio of 6. And you could argue they're a far better company. But, you know, aside from this, easy money has led to the situation we're in now, where policymakers have been able to um, borrow at cheap costs, and now it's biting back, and the interest payments are due, and they're a lot higher than we can basically afford. And the only way to resolve this is printing more money, inflation. And so interest rates are extremely cyclical, as you can see from this chart. I mean, this goes back from 1790 to 2010, and we're somewhere about here kind of now. Um, and you know, they're cyclical. I mean, this chart shows it all. Look at all these ups and downs, and we're in like the lowest down of this whole chart at the minute. Kind of similar to post World War II. And look at what happened that then. I mean, I think they went from 2% post World War II to 14, a bit more than 14% in 1981. I mean, the economy can't handle this, guys. Like, imagine if we had 14% interest rates. I mean, when companies have to refinance, they're done. The- this can't happen. This isn't going to happen. We're not going to have 14% interest rates. And so the only way to resolve this again is printing more money. We've um a lot of people have been talking about, Elon Musk has been talking about Doge, cutting government spending, but these are too far gone, I believe, to be able to make a meaningful difference to the budget deficit. I mean, you know, I think Doge wants to cut it by 1 trillion in the next year or so, but you know, eh, it's going to be really, really difficult to do. Um, and tariffs are inflationary as well. So if we have all these tariffs going on, they're going to be inflationary. Um, so yeah, it's difficult. There's no easy answer to all this. So the Fed has basically, inflation is sticky. They've got a problem. It means, rates are, you know, it means they have to hold rates higher for longer. So, you know, they've got a 2% target. We've not been hitting that. And, obviously it's a lot higher than 2%. Some things are up 10% every year. I mean, things that actually matter, right? Um, but if we have these higher rates, it's going to lead to slower growth, unless there's some sort of productivity miracle. I know we've got AI, but for that to really kick in, a lot's got to happen. And if they start cutting interest rates, printer go brr. Inflation, inflation, inflation. That's the thing that we keep coming back to. And President Trump tweeted this a few days ago. You know, this would be a perfect time for Fed Chairman Jerome Powell to cut interest rates. He's always late, but he could now change his image and quickly. Energy prices are down, interest rates are down, inflation is down, even eggs are down 69%, and jobs are up all within 2 months. A big win for America. Cut interest rates, Jerome, and stop playing politics. So we know President Trump's stance on interest rates. He wants them lower, and you know he's pressuring Jerome Powell here, the Fairman, the Fed chairman here, to do that. And you know, Donald Trump's policies are highly inflationary. Um, I think that that's just an obvious thing that people have to bear in mind. So, in terms of investing, I think one of the reasons we've had such, you know, volatile markets in the past few days and um why we've had the gains we've had is due to tech and low interest rates, or tech which has been driven by low interest rates. So this is I didn't really realize how mental this was until I saw it. But on the left, we have the S&P 500 weight by sector, 2014, uh, 11 years ago. And if you look at the biggest sector, it's materials, and they were almost 20%, and tech was um, 3.5%. Whereas if you look at it in 2025, we have tech at almost 30% and materials 2.6%. And I mean, even look at energy, 2.4%, whereas it used to be 10.1%. I mean, it's mental how over bloated some sectors have gotten. Um, I mean, in terms of the value they provide, you could say energy is one of the most important sectors because without energy, there's nothing. However, this doesn't reflect this, and that's why I think, part of what we're seeing over the past few days is potentially there could be a reweighting to a lot of these kind of smaller sectors currently. So, materials, energy, industrials, consumer staples, things like that. A lot of the money from the tech could flow into those sectors because, um, you know, you have to remember money doesn't just disappear, it doesn't vanish. Um, Everything that's down the first most likely thing people are going to be buying is treasuries. However, because of inflation, and if, as we've been talking about with President Trump and Jerome Powell, if interest rates get cut, um, people are going to get a negative return, real return on their treasuries. You'll get a 5% yield, inflation could be 5%, or, something like that, and you just wouldn't get any yield in real terms. So the money has to go somewhere, and that's why I think a lot of these sectors, hard assets, you know, energy, real estate, materials, utilities. I think these kind of value plays are going to be the next kind of thing over the next decade or so because, you know, how high can Nvidia go? Or how high can Tesla go? Um, and I think a lot of this has been driven largely by passive as well. I mean, like everybody's 401k in America is basically within 17 different stocks. So if whenever you put money in your 401k, if it goes straight into that, I mean, that's what's causing a lot of this overweighting. The way the S&P works and the way it weights things, it kind of causes a lot of these problems. So I think that's something to bear in mind. But you know, what's the implications for investors? So as I've already said, we're gonna, you know, it's likely gonna have negative bond yields. Um, Even if they say inflation is 3%, is it really? Is it? If they say it's 2%, is it, or is it more like five if I go to the shops for a weekly supermarket run, Um, I think investors are going to turn to hard assets and commodities. I mean, look, if you look at the markets today, um, or on Friday, the price of gold is like over 3 grand, um, and everything else is just down. I think people, this is like a kind of a signal people should be looking at, Gold is going through the roof. Nothing's stopping it. I mean, it's outperformed the S&P over the past 20, 30 years. Um, but I mean, even look at this past year. I mean, it's gone from like 2,500 to 3 grand, which is astounding, really. I didn't think it would go that high, but you know, I, I'm very, I'm keeping an eye on that to see where that goes later on in the year. I think it could be something. I think that could be something investors turn to, and silver as well. Um, those are kind of the things to look out for. But yeah, that kind of concludes my little rant that I wanted to go on today. I hope you learned something. Maybe you did, maybe you didn't. I hope you enjoyed. Um, and yeah, I'm gonna start making more videos. I enjoyed doing this. Um, Thank you very much for watching. Sigma Max Capital.